I need you to stop whatever you're doing right now and pay attention. Gold just broke below 5,100. Silver is in freefall, not a pullback, not a correction, a freefall. Silver went from $96 to below 80 in a matter of hours. That is not normal. That has never been normal. And I am going to tell you right now, this crash is not over. It has just begun. I am going to show you exactly why. I am going to show you who is behind it. And at the end of this video, I'm going to break down what every major crash like this in history has looked like and how it ended, because the pattern is the same every single time and nobody is talking about it. Stay until the end, because that breakdown is going to change how you think about everything happening right now. But first, I owe you something. I owe you honesty. In my last video, I told you 85 to 86 was the floor for silver. I told you that was the new 70. I told you it should hold. It did not hold. 85 broke. And when it broke, silver did not just dip below it and bounce. It fell through like there was nothing underneath. And that tells me something very important about where we are right now. But here is what I was not wrong about. In my members only video weeks ago, I gave you 95 to 102 as the exact zone where silver would make its next lower high. Silver topped at 96. That call was precise. The top was right. The support was wrong. And the fact that the support broke this violently is what changed everything about my outlook. So let me walk you through what is actually happening right now. Gold gapped up this morning from 52.78 to 5,400. I told you in my last video that 5,400 was the level. Either it breaks through and we go to all-time highs, or it gets rejected hard. It got rejected hard. Gold touched 54.18 and then it started falling. But it did not just fall to 52.50 and stabilize the way a normal rejection would. It kept going. 5,200, then 5,100. And as I'm recording this, gold is below 5,100 and still falling. That is not a rejection. That is a breakdown. When a major resistance level rejects price and price does not find a floor anywhere near the rejection zone, that tells you the selling pressure is overwhelming the buying. The buyers who gapped gold up this morning have already been wiped out. Their stops have been hit. Their margin has been called. And the selling is feeding on itself. Now let me explain why silver is crashing even faster than gold, because this is the part that is scaring people the most, and I need you to understand the mechanics so you do not make a decision based on emotion. Silver is a leveraged play on gold. I have said this before, and I will keep saying it until everyone understands it. When gold drops 5%, silver drops 15. When gold drops 10%, silver drops 25 or 30. The leverage works in both directions, and right now it is working in the worst direction possible. Gold is down several $100s from its high. Silver has been cut nearly in half from its recent highs. That is the leverage multiplier doing exactly what it does. But here's what makes this particular crash different from a normal leverage sell-off. This time, the selling is not just coming from retail panic. There is something much bigger happening underneath. I want to show you something that just broke today. Pull this up on screen. $9 billion was just pulled from the Federal Reserve repo market in an emergency liquidity draw. $9 billion. Let me explain what that means, because most people hear repo market and their eyes glaze over, but this is the most important chart I have shown you in months. The repo market is where banks go to borrow cash overnight. The Fed created a standing repo facility after the 2008 financial crisis so that banks could always access emergency liquidity when they need it. Think of it like a hospital emergency room for banks. They show up when something is wrong. For weeks, the repo market was flat. Nobody was using it. Nobody needed emergency cash. Then today, March 2nd, someone pulled $9 billion, $3 billion in treasuries, and $6 billion in mortgage-backed securities. That is a bank, or multiple banks, showing up at the emergency room and saying, we need $9 billion in cash right now. And remember what Bloomberg reported just hours ago. U.S. treasuries are falling, bonds going down during a war, the 2-year yield at 3.44%, the 10-year at 3.99%. The Fed's next rate cut pushed all the way back to September. European inflation, swaps jumping 11 basis points because of the Hormuz closure. The bond market is not providing a safe haven. So where does the money go when bonds fail, gold is being liquidated, and banks need emergency cash? It goes nowhere. It evaporates. That is what a liquidity crisis looks like. Cash becomes king. Everything else gets sold to raise it. Now ask yourself why. Why today? Why during the biggest single-day crash in gold and silver in recent memory? Why while the Strait of Hormuz is down 70%? Why while Trump is saying the big wave has not happened yet? The last time the repo market showed this kind of stress was September 2019, when overnight repo rates spiked to 10%, and the Fed had to step in with emergency injections. Before that, it was 2008. Both times the repo stress was a leading indicator. It was the warning light on the dashboard before the engine blew. 9 billion in one day does not mean the system is fine. It means someone somewhere is bleeding and they needed a tourniquet. Here's what I think is happening, and I want to be clear, this is my analysis, not confirmed fact. Margin calls. When gold and silver crash this hard, this fast, every leveraged position in precious metals gets a margin call. The banks and funds that were long gold and silver on leverage have to come up with cash immediately, or their positions get liquidated. And when they cannot come up with the cash from their normal operations, they go to the repo market. They go to the Fed's emergency window. $9 billion of emergency borrowing on the same day gold and silver are in free fall is not a coincidence. That is the sound of leveraged positions blowing up in real time. And here is why that makes the crash worse. When a fund gets a margin call and cannot meet it, the broker liquidates the position. They sell the gold, they sell the silver, they sell at market price, which pushes the price down further, which triggers more margin calls on other funds, which causes more forced selling, which pushes price down more. It is a waterfall, a cascade of forced liquidation where every sale creates the conditions for the next sale. That is what freefall looks like. That is what you are watching right now. This is not people deciding to sell gold because they do not believe in it anymore. This is people being forced to sell because they ran out of margin. There is a massive difference between voluntary selling and forced liquidation. Voluntary selling finds a floor because sellers stop when they think the price is low enough. Forced liquidation does not find a floor until the margin calls stop. And the margin calls do not stop until the price stabilizes long enough for the remaining positions to get recapitalized. That has not happened yet. Welcome to the hidden economy. If you are new here, I called the 95 to 102 top in silver weeks ago in the members only video. I called 5400 as the resistance in gold. Both played out exactly as I said. If you want to stay ahead of this market, hit subscribe and hit the hype button right now. What I am about to show you next is critical. Let me connect the dots between the crash and what is happening in the real world, because the disconnect right now is the most insane thing I have seen in my career covering these markets. The Strait of Hormuz, traffic is down 70%. Only Chinese and Iranian ships are going through. Let me put that in numbers. 20% of the world's oil passes through that strait. If traffic is down 70%, that means roughly 14% of global oil supply is being disrupted right now. 14%. The 1973 oil embargo disrupted about 7%, and it caused a global recession. We are looking at double that disruption. Oil should be at $200. Gold should be at $6,000. And instead, everything is crashing. Gold is crashing. Silver is crashing. Bonds are crashing. Bitcoin is crashing. Everything. All at once. The only explanation that makes sense is forced selling across the board. This is not the market pricing in peace. This is the market being forced to sell everything to raise cash for margin calls. When everything goes down at the same time, that is a liquidity crisis, not a change in fundamentals. Now, either we are completely wrong about everything, and this war is going to wrap up in the next 48 hours, and the strait is going to reopen, and everyone goes home. Or the market is going to collide with reality in the most violent repricing event any of us have ever seen. There is no middle ground here. The fundamentals say one thing and the price says the opposite. One of them is wrong. And in my experience, it is always the price that catches up to the fundamentals, not the other way around. And while all of this is happening, while gold is in free fall and silver is getting destroyed and banks are pulling $9 billion from the repo market, the President of the United States goes on CNN and says this: "We have not even started. We are about to hit them hard. The big wave has not happened. It will come soon." And Senator Lindsey Graham is talking about Cuba being next. The war is not ending. It is expanding. The man in charge is telling you on live television that what you have seen so far is the warm-up. And the market is selling gold. This is the disconnect. This is what makes no sense on the surface. But it makes perfect sense when you understand the mechanics. The market is not selling gold because the war is ending. The market is selling gold because leveraged positions are blowing up and margin calls are forcing liquidation. The reason does not matter when the margin call hits. It does not matter that the Strait of Hormuz is closed. It does not matter that Trump says the big wave is coming. When the broker calls and says, deposit cash in 2 hours, or we sell everything, you sell everything, that is what is happening. The fundamentals have not changed. The positioning has changed. And positioning drives short-term price. Fundamentals drive long-term price. Right now we are in the short term, and the short term is brutal. Now let me talk about what the technicals are telling us, because this is the part that I covered in my members-only videos weeks ago, and it is playing out exactly as I warned. I gave the 95 to 102 zone as the area where silver would make its next lower high. Silver topped at 96. That was the lower high. The pattern was set. Lower high means the trend has shifted from up to down. And once a lower high is confirmed, the technical target becomes the previous low. But when the previous support at 85 broke, the target shifted much lower. This is where technicals matter more than news. And I know that sounds crazy to people because how can a chart matter more than a war? But it does. The market proved it today. Missiles flying. Strait of Hormuz shut down. President threatening bigger attacks, and gold dumped hundreds of dollars. Silver dumped even harder on a percentage basis. The news did not matter. The technicals mattered. 5400 was resistance. It rejected. 85 was support. It broke. The charts do not lie, and they do not care about your feelings or mine. They just show you where the orders are. And the orders at 5400 were sell orders. The orders at 85 were stop losses. Both got triggered. Both did exactly what the charts said they would do. Let me explain what the banks and institutions are doing during this crash, because people keep asking me this, and the answer is going to make you angry. They are manipulating the price. I do not say that lightly. I am not a conspiracy person. But look at what is happening. Silver went above $100. Retailers piled in. Premiums went through the roof. Everyone was excited. Then they dumped it hard. Back to 85. Some retailers sold at a loss. Some held. Then it bounced to 96, and the retailers who held felt relief. Finally. Maybe it is recovering. Maybe the worst is over. Maybe I was right to hold. And then they dumped it again. Below 80, the same playbook. Pump it up. Let retail pile in at the top. Dump it. Let them feel pain. Let it bounce a little. Let them feel hope. Then dump it harder. That is the cycle. That is how the transfer of wealth works in precious metals. It does not happen in one crash. It happens in a series of crashes where each bounce gives retail just enough hope to stay in before the next leg down takes more from them. They did it at 100 plus. They did it at 85 to 95. And the pattern repeats until the weak hands are completely out. That is not theory. That is what the chart looks like right now if you zoom out and trace the path from the highs. And here is the proof. Look at the Comex delivery data from this morning. 24 million ounces of silver demanded for delivery in March. Banks taking delivery. Physical metal moving from vaults to accounts. The price is crashing and the metal is moving into stronger hands. That is not a market that is broken. That is a market that is being shaken. There is a difference, and that difference is everything. A broken market has no buyers. A shaken market has buyers who are accumulating while everyone else panics. The Comex data shows you the buyers. They are the same banks that are dumping the paper price. They crash the paper, trigger the margin calls, force retail to sell, and then they take delivery of the physical metal that retail was forced to let go. It is the oldest game in finance. Create the panic, profit from the panic. And retail pays the bill every single time. Now I want to show you what I think is the most important part of this entire video. The part I told you to stay for, the historical pattern. Here is where it gets real. Every forced liquidation crash in precious metals history has followed the same pattern. 2008, gold dropped over 30% in a few months during the financial crisis, while the world was literally collapsing. Lehman Brothers went under. AIG got bailed out. The entire banking system was on life support, and gold went down. Not because gold was not a safe haven, because leveraged funds were getting margin called and they had to sell everything, including gold, to raise cash. Silver got cut in half. The fundamentals were screaming one thing. The forced selling was screaming the opposite. Price went down while the reasons to own gold and silver went up. And then when the margin calls stopped, when the forced selling exhausted itself, gold went from under 700 to over 1900 in the next 3 years. Silver went from under $9 to almost 50. The liquidation was temporary. The fundamental repricing was permanent. 2011. Silver crashed from 49 to 26 in a matter of weeks. 50% gone. Leverage blew up. Margin requirements got raised multiple times. Forced selling cascaded through the system the exact same way it is cascading right now. And the people who were holding physical silver and did not sell into the panic were the ones who got to watch the next cycle unfold from a position of strength. 2020. Gold dropped from 1700 to 1470 in March when COVID hit, and the entire market liquidated everything for cash. Everything went down at once. Gold, stocks, bonds, crypto, everything. The correlation went to 1 because when everyone needs cash at the same time, everything gets sold regardless of its fundamental value. Same pattern. Liquidity crisis. Forced selling. Panic. And within 5 months, gold was at 2,000 and hitting all-time highs. The forced selling lasted weeks. The recovery lasted years. The pattern is the same every single time. A crisis causes prices to spike. Leverage builds up. Then something triggers a liquidation. Everything crashes, including the safe havens. The people watching from the outside say gold is dead, silver is dead. The thesis was wrong. And then 6 months later, the price is higher than it was before the crash started. Every single time. Now, I'm not predicting timing. I am not telling you where the bottom is. Nobody knows that. What I am telling you is that forced liquidation crashes during geopolitical crises have a 100% historical track record of being temporary. The question has never been whether the price recovers. The question has always been who is still in the game when it does. But here's the part that nobody else is going to tell you. And this is the most important thing I will say in this entire video, so listen carefully. The crash in price does not change the fundamentals. Not by 1 ounce. The Strait of Hormuz is still down 70%. The war is still expanding. Trump is saying the big wave has not happened yet. Banks pulled $9 billion from the repo market today. The supply deficit in silver has not changed. The industrial demand has not changed. Central banks are still buying gold at record pace. The only thing that changed is the paper price on an exchange where leveraged positions got liquidated by margin calls. The physical metal did not get cheaper. The paper contract got cheaper. And when the margin calls eventually stop, because they always do, the price is going to have to reconcile with the reality that the world is more dangerous today than it was when gold was at 5,400. Let that sink in. The world is objectively more dangerous right now than it was 48 hours ago. More escalation, more threats, more disruption. And the price is lower. Historically, that kind of disconnect does not last. Forced liquidation creates temporary dislocations between price and reality. And reality has a way of reasserting itself. Sometimes it takes days, sometimes weeks, sometimes longer. But the dislocation between what is happening in the world and what the price says has never been wider than it is right now. That is not a prediction. That is a measurement. If you are holding physical metal right now and watching your portfolio bleed, here is what is happening mechanically. Your metal is still in your hands. Nobody took it from you. The number on a screen changed. The weight of that silver bar did not change. The purity did not change. The supply deficit did not change. What changed is that leveraged funds on Comex got margin called, and their forced selling created a paper price that is disconnected from what is happening in the physical market. Understanding the difference between a paper price crash and a physical supply crisis is the most important distinction you can make right now. They are two completely different things happening at the same time. If you were on leverage and you got liquidated, what happened to you is exactly what happened to the funds that caused this crash. Leverage amplifies in both directions. It gives the highs, but it takes everything on the lows. In a market this volatile, with wars and repo crises and 70% straight closures, leverage is the single most dangerous variable in the equation. History shows that every major precious metals crash was made worse by leveraged positions unwinding. Every single one. That is not opinion. That is data. And if you are sitting on the sidelines watching all of this, here is what to pay attention to. These are the signals that have historically marked the end of forced liquidation events. First, the asset needs to find a level and hold it for at least 2 or 3 full sessions. Not 2 or 3 hours, 2 or 3 days. A real floor where buyers show up and defend. Second, the selling candles get smaller, the volume drops, the price starts chopping sideways instead of waterfalling down. That is exhaustion. Third, the repo market calms down. If banks are still pulling billions in emergency liquidity, the forced selling is not done. Fourth, watch the Shanghai premium on silver. If Shanghai holds a massive premium over Comex during this crash the way it did during the first leg down, that tells you the physical market is not confirming the paper crash. That tells you the paper price is disconnected from physical reality. Those 4 signals have preceded the end of every major liquidation event I have studied. None of them are flashing yet. Now, as I am recording this, gold and silver are trying to recover. And I know some of you are looking at the green candles and thinking, okay, maybe the worst is over. But understand how markets work during a crash. They do not just fall straight down and stay there. They create lower highs. They bounce. They give you hope. And then they make the next move to the downside. That is the structure. Lower high, lower low, lower high, lower low. Until the selling is done, the fact that it is bouncing right now does not mean the crash is over. It means the market is building the next lower high before the next leg down. That is what extreme volatility looks like. And these metals are as volatile right now as I have ever seen them. I told you when this war started that March was going to be an extremely volatile month. Get ready for pumps and dumps. This is what I meant. The pumps feel like relief. The dumps feel like the end of the world. Neither one is the full picture. The structure is the full picture. And the structure right now is lower highs. Drop a comment. Tell me where you think gold and silver bottom. Tell me if you are holding or if you got shaken out. Tell me if you think the war wraps up or if Trump really is about to send the big wave. I want to hear it. I will pin the best analysis. Share this video right now, urgently. There are people in your life who own gold and silver and they are watching their portfolio collapse, and they do not understand the mechanics behind it. They do not understand the difference between forced liquidation and fundamental breakdown. This video explains it. Help me reach them. If you are new here, go watch the previous videos. I called the 95 to 102 top. I called 5400 resistance. I called 85 as the critical level. Every single call is on camera. Links in the description. And if you want the calls before they happen, join the members only community. That is where I posted the 95 to 102 target weeks before it played out. This is the hidden economy. The crash has just begun, but so has the biggest disconnect between price and reality I have ever seen. Stay sharp. Stay educated. The number on your screen is not the metal in your hand. Know the difference. I will see you in the next one.